Get Rich Slow with John Wolf. Hey, today I want to explain to you how property type and the property itself affects both your closing costs, the loans you're allowed to do, and most importantly, the pricing on that loan. So I'm almost exclusively here going to talk about conventionals, but I'm going to take a little aside to talk about a few special examples of FHA and VA. Okay, so John, why would the property affect the closing costs? Well, there's two big reasons. Probably the biggest is actually because properties have different tax amounts, and depending on the time of year in Oregon, as a lender, we might have to hold back or pre-collect 15 months, up to 15 months worth of property taxes. And that can be a big chunk of change. So if it was 12 months, which is a different time of the year, you have to collect 12 months worth of property taxes, and a property is $2,000 a year property taxes, then I have to collect $2,000. If it's $5,000 a year, I have to collect $5,000 at closing. Well, that's a lot of cash out of pocket. And the difference can be huge, especially when the house I'm sitting in right now and the house 3 over, mine is about $4,000 and his is almost $8,000. Same size properties, house even look a little bit alike. I mean, theirs looks nicer, but hey, I'll take it. Anyways, so that's the biggest thing. And then the next most important thing has to do with the loan itself and the sort of cost associated with different loan types. So it surprises a lot of people, and it definitely surprised me until I had it fully explained to me and kind of saw it play out. Different property types have different loan costs or interest rates or points attached. And please watch my other videos about how the points and interest rate can be converted. So anyways, the sort of gold standard property type is a single family home that you're going to live in. That's the cheapest possible. Now, townhomes are sometimes the same price, but if they're really condos, and that has to do with the legal description, condos are more expensive to finance than single family homes. So you either have to take a higher interest rate or higher closing costs, side-by-side comparison. Now, even more expensive often are manufactured homes. There are even stranger and more complicated things. So for example, if you wanted to buy, a hobby farm, you probably wouldn't be able to do conforming financing, although there's a really good chance you could do VA. And outside of that, the most expensive financing-wise type of property to do is a conventional multiplex, especially a 3-4plex. There is an extra risk associated with multiplexes to the lender, and they're harder to sell. There's more families who could potentially ruin the property. That's why. Now, you can actually stack other complicating things. So if you're getting a property as an investment that you're never going to live in, that's a significant price add as well. And then when we're talking about refinances, cash out refinances, at least conventional, have a significant price add over just your standard vanilla conventional. And all of those things stack. So if you are refinancing and getting cash out of a 4-plex investment property, the interest rate and or fees will look astronomical compared to if you were looking at refinancing a rate term without taking more cash for a primary residence, or if you were just purchasing a primary residence with a conventional. Now, I kind of buried the lead because I like cool, exciting things, and the sort of cool, exciting loan thing about this pricing discussion is duplexes, 3-plexes, 4-plexes, and VA or FHA. Now, I do want to be very clear that getting a multiplex, especially a 3-4plex, is a much more complicated endeavor than buying a single family home. And if you want to get in the whole get rich slow lifestyle like me, please watch my other videos on it. But the long and the short of it, and my sort of just blanket warning is, if you are interested in getting into home investments like that, you should be 100% willing to pay for the appraisal, do the home inspection, and if anything goes wrong or isn't right, just walk away and not be upset. If you can't lay out that $2,000, this isn't the game you should be playing. It's kind of like, anteing up in poker. Now, that's a lot of money for some people, and that's part of the reason I warn people ahead of time, because the chances of that transaction not making sense after you get into it is just way higher. Fourplex has 4 times more things to go wrong. But here's the cool thing, FHA and VA. So VA and FHA have basically the same price for a single family home, which their price is good, as a fourplex. And a fourplex conventional is much higher down payment minimum, much higher pricing than FHA or VA. So just for an example, just to make this really clear, if you are a veteran and you don't already have a VA loan, or if you did, it's fully paid back, you could buy a $1 million fourplex with 0 down and no mortgage insurance. If you're not disabled, you have to pay the 2.3% upfront rolled into loan. And if you are disabled, it's just nothing. Now, there are a few extra complications with buying a VA fourplex, but as long as you're working with an experienced real estate agent and loan officer, we shouldn't have too much of a problem navigating those. Now, almost the exact same story with FHA, except you don't have to be a veteran, and we appreciate our veterans, of course. But the really neat thing, and it's what I did, is you can buy a fourplex, move in there for 1 year. After 1 year, you can move out and even rent that 4th unit. And it's not super easy. There's probably like 1 property in the Portland metro area that really makes sense for this a month average. But you can put just 3.5% down, get a $900,000, $800,000 fourplex, and as soon as you move out of that 1 unit, it should pay for itself and all of expenses, and maybe a few $100s a month just right out of the gate in year 2. And compared to doing normal investment financing where you have to put 25% down, that's amazing. It really is. And the cool thing is, normally conventional fourplexes are about 1% higher interest rate. That's not the real number, but it's a good idea. And FHA, even though they have that mortgage insurance that doesn't go away, it is calculated to be less every year. And the interest rate for FHA is substantially lower than conventional, even for a single family home. So you can actually get that same single family home interest rate on FHA all the way on the big boys for the fourplexes. And that's one of the things that really makes buying multiplexes with those programs kind of amazing. So it's sort of the opposite of a high price story. It's a low price story. You really can, and in fact, it's a requirement for a fourplex. The rents of 3 of the units can make the entire payment, including taxes and insurance. Anyways, if you have more questions about that, check out my other videos. Get Rich Slow with John Wolf. Have an awesome day. Bye.